A Treasury ladder versus an annuity ladder. How much more could you earn? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. So, while some in our community are still happy with auto-rolling T-bills, as we are with our short-term money, a good number of you have also begun to lock in the current medium and longer-term rates on annuities, treasuries, and other types of bonds. Others, though, continue to ponder this top-of-mind question. Should you lock in medium and longer-term rates now or wait? And particularly so after a week like the past one, when Treasury yields were all down, reflecting the current trade tensions between our country and China and the ongoing signals from the Fed about further rate cuts this year as unemployment keeps trending up. And that's before I even mention our government shutdown, which appears to have no end in sight at the moment. We're on day 19 of the shutdown at the time of this taping, which at this point is the third longest shutdown in about 5 decades, with the second longest one lasting 21 days in 1996, and the longest lasting one 34 days in 2019. I know some of you had initially thought our current shutdown would last some 20-odd days. Leave a comment below and let me and the community know. What's your best guess now on how long this will go on for? Not everything is doom and gloom in our economy, though, as we discussed on this past Friday's Member Live. All major stock indices have retreated a bit, but remain close to all-time highs. Even Bitcoin seems to have stabilized again after a sharp drop in between. Plus, the federal deficit for the financial year that just ended on September 30th came in $125 billion better than expected and lower than last year, helped by the extra income from the new tariffs. And the GDP consensus forecast still sees real growth of about 2% for this year. Overall, it's a mixed and somewhat contradictory picture, but our guess at this point is that it looks more like a soft landing than a recession, or even stagflation. But who knows, right? Of course, if your assumption is that rates for treasuries and other fixed income-like investments will continue to come down for longer maturities, which would be consistent with a somewhat weakening economy, you might indeed lock in some of the current rates while they're at levels that look quite attractive compared to the historical averages over the past 20 years. So, with that in mind, here are the 3 topics I'll be covering today. 1. When might you choose an annuity over a bond, such as a treasury or agency? And how much more could you earn with an annuity ladder versus a bond ladder? 2. How do current rates compare for treasuries, agencies, and annuities? And 3. What are the predicted yields for the upcoming week's treasury auctions? The 5-year tips is on the auction schedule. So, let's dive in now, folks. When might you choose an annuity over a bond, such as a treasury or agency? And how much more could you earn with an annuity ladder versus a bond ladder? If you're a retail investor or saver like Marcus and I are, and you want to lock in today's rates for the longer term because you feel that they're still attractive, you don't really have that many choices. So let's focus on 3 of the most popular ones here. First, we have treasuries, of course. They're still widely considered the safest and most liquid investments in the world. They're never callable, and on top of that, the interest earned on treasuries is exempt from state and local taxes when held in a taxable brokerage account. Marcus and I are big fans of treasuries, and we have quite a few in our portfolio that we generally buy at auction and hold to maturity. So what speaks against treasuries, you might ask? Well, nothing really, except that all their strengths come at a price, which means their yields will usually be at the low end of the market. Remember the fundamental principle in the bond universe: low risk, low return. So if you want a bit more yield, the second popular option in our Diamond NestEgg community will likely be agency bonds or agencies. Bonds issued by various entities that are either explicitly or implicitly backed by the federal government. Many agencies that are currently on the market are callable, which means you may not really be able to lock in their rates for the long run, but there are non-callable agencies as well. The risk profile for non-callable agencies is very similar to Treasuries. They're generally a bit less liquid, and maybe those with only an implicit government backing may have a slightly higher residual risk, but generally it's pretty close. And not surprisingly, this also means that their rates are usually pretty close to those for Treasuries. You may be able to pick up a few extra basis points here and there, but this will depend on your personal circumstances. For example, not all agencies are exempt from state and local taxes when it comes to interest earned. And this tax nuance may sometimes wipe out, or even more than wipe out, the potential yield advantage that agencies have over Treasuries if you live in a high tax state, as we do. In addition, you will need to invest a bit of time, energy, and money to go hunting around on the secondary market when it's open for the best rates on non-callable agencies. Because as I just mentioned, most of the new agency bonds that are currently being issued are callable. Bringing us to the third popular option in our community, annuities. Annuities come in many different flavors, as Marcus likes to say it, but for today's video, we will focus primarily on MYGAs, multi-year guaranteed annuities, because in our mind, MYGAs, multi-year guaranteed annuities, are most similar to the Treasuries and agencies that we're talking about here, and it's also what many of you hold in your fixed income portfolio. As a reminder for those of you who may be new to our channel and/or annuities, a MYGA is a fixed deferred annuity that does not generally offer guaranteed lifetime income at the time of purchase. Basically, you invest a lump sum for a set term, typically 2 to 10 years, and earn a guaranteed interest rate with the principal and all accumulated capital paid out at maturity. There are no interest payments before. MYGAs offer principal protection and steady growth, but require reinvestment decisions afterward. Let's take a look now at an illustration of a Treasury ladder versus a MYGA ladder, assuming a $50,000 investment into each rung of the ladder. So here we have the Treasury ladder with a 2-year T-note that earns 3.46%, a 3-year T-note that earns 3.47%, a 5-year T-note that earns 3.59%, and a 7-year T-note that earns 3.78%. All of these are maturities that you can purchase at auction, as I know that quite a few of our Diamond NestEgg regulars prefer to purchase the Treasuries at auction versus on the secondary market. Here now, we have a MYGA ladder with a 2-year MYGA that earns 3.6%, a 3-year MYGA that earns 4.05%, a 5-year MYGA that earns 4.15%, and a 7-year MYGA that earns 4.45%. And what we can see here is that for a 2-year term, the MYGA pays 14 basis points more. And for a 3-year term, 5-year term, and 7-year term, the MYGA pays 58, 56, and even 67 basis points more, respectively. So you could say, based on this illustration, that generally speaking, the further out the maturity of your ladder, the more you're likely to earn on a MYGA ladder versus a Treasury ladder. All the rates shown in this illustration are as of close of market on Friday. Also, keep in mind that overall, and all else being equal, if your investment is less than $50,000 for each rung of the ladder, the difference here will be lower. And if your investment is more than, say, $100,000 for each rung of the ladder, the difference here will be higher. But we'll dive deeper into the exact MYGA rates by investment amount later on. Now, annuities from top-rated insurance companies are widely considered among the safest and most conservative investments on the market, and in particular for retirement planning. So why do they offer higher rates then, right? Well, as a reminder from our previous annuity videos, there are 3 key reasons for the higher rates that annuities offer. 1. Annuities are less liquid than Treasuries and agencies. While many annuities allow you to withdraw some part of your capital per year without penalty, for example, 10%, you'll need to pay an extra surrender charge that is not insignificant if you need more than that amount. A 10% IRS penalty may also apply to the portion of your annuity withdrawal that is considered earnings if you're under 59.5, which is the flip side of the tax-deferred treatment of annuities that I'll speak about in a moment. With treasuries and agencies, on the other hand, you can sell them on the secondary market before maturity at whatever the then prevailing market prices are. So you may have a penalty if you sell for less than you originally invested. Or you may have a gain if you sell for more than you originally invested. And there is one more difference with regards to cash flow. Treasuries and most agencies generally pay you interest every 6 months, while deferred annuities such as MYGAs accumulate all interest and only pay everything out when they mature. 2. Treasuries are generally tax advantageous in the sense that they're subject to federal taxation, but exempt from state and local income taxes when held in a taxable brokerage account, which may or may not be a factor for your personal decision, depending on your circumstances. Annuities are tax advantageous in the sense that they may grow tax deferred, but their ultimate payouts may be subject to your full marginal income tax rate at both the federal, state, and local levels. That said, the taxation of annuity payouts will vary depending on whether you're using qualified funds, meaning pre-tax dollars, or non-qualified funds, meaning after-tax dollars. Please speak with your trusted annuity advisor and or tax advisor if you want to dive deeper here, or drop us a comment below and we'll see if we can do a video on this topic in the future if there's enough interest. Third, annuities are at their core insurance products, even though they are often treated as part of the fixed income portfolio. What this means is that they can get complex very quickly, so you may need to invest a bit of time to fully understand what you're buying. Plus, you'll probably learn a few pieces of insurance lingo along the way. For example, if you want to understand when exactly your annuity will mature, your trusted annuity specialist may start talking about the end of the term, which is the same thing, mind you, but you may need a bit of translation initially. You may want to consider a MYGA if you check one or more of these boxes. You're a yield-seeking fixed income investor looking to allocate a portion of your portfolio with a horizon of up to 10 years to somewhat higher yielding but still stable low-risk assets. And you want to earn a bit more than what treasuries and agencies are currently paying. For example, as part of an annuities ladder, as we're discussing here. You're nearing retirement and want to convert the lump sum payout from a MYGA into a lifetime income stream at maturity. If you're pre-retiree considering annuitization, as the industry would say, you may be able to do this conversion tax-free. The reason is that MYGAs may often be exchanged tax-free into other annuities, like single premium income annuities, or SPIAs, via 1035 exchange. And if that's an option that sounds potentially attractive to you, and you want to learn more about how SPIAs may provide you with a lifelong income to supplement Social Security and other sources, you can find the link to this bond ladder versus SPIA video in the first pinned comment below this video. You may also want to consider a MYGA if you're a conservative investor with a low risk tolerance and seeking safe, fixed returns without market exposure, as a MYGA offers principal protection and predictable growth over its lifetime. You're a tax-conscious investor. For example, you're in a higher tax bracket now, and you might be able to benefit from tax-deferred growth if you can delay withdrawals until you're in a lower tax bracket. You're a long-term saver with at least a 2-year investment horizon who doesn't need immediate liquidity. Most of our Diamond NestEgg members, super savers, and course fans who've purchased annuities recently are older, and they do fit neatly into one or more of these boxes. Some even fit into all of these boxes. So if this sounds like you, shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists, because there's no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Or check out the rest of these annuity videos here if you want some more background first on the different types of annuities that exist on the market. I've linked the full playlist in the first pinned comment below for your convenience. And like I often say, it's rarely all or nothing when it comes to money and investing. If we go back to this illustration of a Treasury versus MYGA ladder, another option here may be to substitute, say, this 2-year T-note at 3.46% for this 2-year MYGA at 3.6% in the MYGA ladder. At a 2-year term, the MYGA is only paying 14 basis points more than the T-note. So you're not giving up so much by going with the 2-year T-note. Plus, the 2-year T-note would give you more flexibility in the near term. If you ever needed the extra cash, you could sell some or all of your 2-year T-note instead of worrying about surrender charges and potential IRS penalties with the 2-year MYGA. And of course, you could even throw in some CDs here if it suits your individual circumstances, goals, and expectations. If you're looking to lock in rates for longer than 2 years, though, as I know quite a few of you in our community are, the CD rates that we could find on such longer maturities were simply not very attractive, especially if you live in a high tax state. Because remember, interest earned on CDs is also fully taxable at the federal, state, and local levels. And because I know this question will come up, no, you don't need to build a ladder. If you know that you do not need your funds for, say, 5 or 7 years, and you're comfortable doing so, you could also simply just put your cash into a Treasury, agency, or MYGA with a term that matches your time horizon from the get-go and grab those higher long-term rates from the very beginning. Right, so now that you know when you might choose a MYGA over a Treasury or agency and how much more you could earn with an annuity ladder versus a bond ladder, let's dive even deeper into the rates across the 3 products. How do current rates compare for Treasuries, agencies, and annuities? Here is our table of annuity, agency, and Treasury rates that a number of the savers in our community have requested, organized from the overall highest rates to the lowest rates. As I've mentioned in our annuity series this year, annuity rates and payouts are largely driven by interest rates. And because interest rates have been at decade-plus highs the past few years, annuity rates and payouts have also been at decade-plus highs. At the time of this taping, here are some sample rates for MYGAs from a AA+ rated insurance company that we work with. Here you have the investment amount, and for each investment range, here's a rate for 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. So for example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this carrier, your rate might be 4.35%. A $50,000 7-year MYGA might earn you 4.45%, and a $100,000 MYGA might earn you even 4.6% for 7 years. So for those of you who've signed your annuity contracts recently, congratulations, because these 7-year rates are down about 25 basis points from last week, while these 3-year to 6-year rates are down about 5 basis points from last week. The 2-year rates are unchanged from last week. But who knows, right? If medium and long-term bond yields move back up, the MYGA rates on this table may also move up again. The documentation that I have at the current time indicates that these rates are effective as of this coming week, starting on Monday, October 20th. However, they are subject to change at any time without prior notice. And please also note that your personal rate may be higher or lower depending on your investment amount, annuity type and term, the insurance company's credit rating, your state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's compare the rates on MYGAs against agencies and Treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be, as you know from before. And as this table shows, the rates on agency bonds range from as low as 3.48% for a 2-year term up to 3.87% for a 7-year term. So down a fair bit from last week on the longer end, when it was 4.14% for a 7-year term. And yes, these are rates for non-callable agencies, only to make it comparable to MYGAs and Treasuries. Callable agencies may show higher rates, but they are not locked in beyond the first possible call date, which is something to be aware of. And the rates on Treasuries range from as low as 3.46% for a 2-year term up to 3.78% for a 7-year term, as discussed in our Treasury ladder versus MYGA ladder illustration from earlier. The black sections here indicate that the rates for these maturities were not available. And what we see here is somewhat similar to last week, that for a 2-year term and for amounts under $100,000, rates on MYGAs are just a few basis points higher than agencies and Treasuries. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates win, and more substantially so the further out you go and the more you invest. But just to remind you, you'll need to be comfortable with the illiquidity of MYGAs, as well as the lack of regular interest payments, if you want to lock in these rates for the long run. So again, if you've been thinking about annuities either for the higher rates or for the guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist, or shoot us an email at jennifer@NestEgg.com so that we can connect you with our trusted annuity specialist to see what your options may be. Let's take a look now at our usual table with Treasury yields from this past Friday versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Decreases in rates are shown in red. Yields are down across the board versus the previous week, as we've touched upon towards the beginning of today's session. Now, the yield declines this week were less steep than last week, but still, they may reflect the current trade tensions between our country and China, the ongoing signals from the Fed about further rate cuts this year, as well as the government shutdown, which seems to have no end in sight. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, this last row here shows the increase or decrease in rates since the beginning of this year. Decreases in rates are shown in red. As our Diamond NestEgg regulars know, Treasury yields have been below the peaks that we saw at the beginning of the year for a while, and we're also still seeing the lowest yields in the middle of the range, especially for the maturities from 2 to 5 years, which may mean that investors continue to view Treasuries as a safe haven, but don't necessarily feel comfortable with locking themselves in for too long with a 20 or even 30-year T-bond, especially given the current volatility and uncertainty in the market. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where rates ended the week, let's move on to the next section of today's discussion. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bills are happening as usual. The 20-year T-bond and the 5-year TIPS are also on the schedule, as we discussed in our member live on Friday evening. The 20-year T-bond auction is a reopening auction, so we already know what the coupon will be on that. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 13-week at 3.875, the 26-week at 3.782, and the 6-week at 4.014. So overall, not too different from last week. For the 20-year T-bond reopening auction, the coupon is 4.875, and the expected yield is 4.575, which means that buyers in this reopening auction will likely pay above par, given that rates have moved down since this coupon of 4.875 was set at the original 20-year T-bond auction a few weeks back. For the 5-year TIPS auction, the expected coupon is 1.125 and the expected yield is 1.170, which is lower than where it was on average over the past 12 months, but is still higher than the current I-bond fixed rate of 1.1%. So if you're comfortable with TIPS, this may be something to take a closer look at. Remember, though, that whereas I-bonds are pretty much straightforward, TIPS, like annuities, can get complex and fast, especially if you need or have to sell those TIPS before maturity. That said, for the right investor who's willing to invest a bit of time to understand them, they may be worth the effort, as both TIPS and annuities offer something that's not easily available from other investments. Bond beginners, folks, please refer back to these 2 modules here on TIPS and I-bonds for a refresher. Also, the break-even inflation rate on the 5-year TIPS was 2.29% at the close of market on Friday. Do keep in mind that we and the overall market are currently flying a bit blind here, though, given that we're working off of fairly old inflation numbers. As a reminder, the latest inflation report from the BLS, the U.S. Bureau of Labor Statistics, before the government shutdown, showed annual inflation coming in at 2.9% overall at the end of August, and core inflation coming in at 3.1%. So, if the 5-year TIPS fits your timeline, goals, and expectations, and you want to add some inflation protection because you believe that inflation over the next 5 years will average more than 2.29% annually, and you're comfortable with the complexity, overall lower liquidity, and tax nuances of TIPS, then this may be an auction to consider dollar cost averaging into. Please also keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. And for those who may have missed our community post from Friday, or who've reached out about an update on our November I-bond rate projection, that video will be coming out next weekend as part of our weekly update, after the BLS publishes the September 2025 Consumer Price Index, CPI, this coming Friday, October 24th. And this will happen even if the government shutdown continues. The BLS has said that the publication of the inflation report will be a one-off exception during the shutdown, so that the Social Security Administration can adjust benefits in time for the new year, when the increased payments will hopefully begin. This is clearly good news for the retirees in our community, as well as for those of us who want clarity on the inflation adjustment for the TIPS and I-bonds that we hold in our portfolio. Plus, the updated numbers may potentially have some influence on the Federal Open Market Committee's rate decision when it meets the next time on October 28th and 29th. According to the CME Fed Watch tool, though, at the current time, the market is pretty much predicting a 100% probability of a 25 basis point rate cut from the current range of between 4 and 4.25% to a lower range between 3.75 and 4%. So drop a comment below and let me and the community know, are you still auto-rolling your T-bills? Or are you going a bit longer with TIPS, T-notes, and T-bonds? Or agencies and annuities? Or is it Bitcoin, gold, or something else altogether? Curious minds want to know. And if the annuity rates in this table have piqued your interest, do check out these annuity videos here or drop us a note at jennifer@NestEgg.com so that we can connect you with our trusted annuity specialist, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. All right, members, super savers, and bond course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.